Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, August 23rd, 2024. It is 11:45 a.m. Eastern Time. I'm starting this video, and probably be the only video today. I'm going to be leaving town for the weekend. My wife and I later today. I'll be around for a little while, so if I see anything that stands out, I'll get out to you. But I really want to do an update on the markets now that Powell's out of the way with the Jackson Hole Summit. I've got some new levels to show you, kind of give you my thoughts on the market and my own trading plan for what that's worth. All right, so we have ES right here. So on both NQ, ES, QQQ, the indexes, I've added some new uptrend lines. Remember, recently I've been highlighting these uptrend lines right here, which we broke down and went sideways. And now I've added this additional trend line here coming off pretty much the lows. Comes right off the low on NQ and QQQ and comes in and captures these recent lows. So now this is the current uptrend line that I'm looking at. I always say charts are dynamic, meaning they're evolving day by day, they're changing. So you're going to have new levels to add to them. And this is a trend line I think that is significant. And that means we've been riding up it today. I'll zoom in a little tighter for you here. I think a solid break of the trend line. Now look, when we reversed yesterday, we hit, and these are the same levels I've given you on this chart for a while here, this 55, 91, 50. It's really good support for ES. You had a lot of reactions, highs there. There was a breakout, new highs, failed. The breakout failed here. When it failed, they came up one more time, tried to see if they could get above there, and they got smacked down hard. And so recently it was resistance again, and we broke out, and there's a successful back test. So that puts, at this point in time, unless that goes, kind of puts the bulls in the driver's seat in the near term. So that's a level that needs to get taken out in order to open up the door, and it'll be quite bearish if we do. So I have the trend line, which comes in right here, but just below that is the 55.91 level again, that in the fact we bounced off it again yesterday helps to further validate it. So that is one of the most important near-term levels. Likewise, this level here, the recent highs are important. I'm going to drill down to the 1 minute charts. Believe it or not, I usually don't use 1 minute charts unless I'm talking about active trades. Most of this site's about regular swing and trend trading. Positions that last usually are measured in weeks or months. But there's some significant levels that I noted today earlier on the near-term charts, which are going to probably determine whether we close green or red today. I'll get to those in just 1 second. So there's your levels to watch. It is worth noting, the S&P 500, to me, it's not the most important index. It's the one that to watch is the NASDAQ 100 simply because it has a more concentrated weighting of the stocks that matter. It has the same top holdings as S&P 500. They're just much more concentrated. I'm talking about the Mag 7 stocks. That's everything what this market's all about. So that's our previous high there, which was a divergent high followed by a breakdown. And so either way, this is where we reversed yesterday. And I just wanted to say, so the S&P 500 is closer to its previous highs, but again, I'm going to get to the NASDAQ 100 in just 1 second. If the S&P 500 does punch above the this pretty much this 56, 61-ish resistance or yesterday's highs, if it does it anytime soon, it will still have negative divergence. And as I often say, breakouts that occur with overbought conditions and negative divergence have a much higher rate of failing. So, to me, the previous highs in the NASDAQ are more significant than they are in the S&P. And we could go in and double top. I just want to say anything much above this, anything much above that high, will most likely or almost certainly take out the negative divergence. What does that mean? When you go over and you no longer have equal or lower highs in the indicators, with prices making higher highs. That's what gives us negative divergence. Prices making higher highs, as they have been, and the indicators making lower or equal highs. So that's what and when we take out the divergence, there's really, on the 60-minute charts, it's almost a foregone conclusion we're going to go to have a decent rally above, could be a few percentage points, maybe more, Not my preferred scenario, just something I'm pointing out. Now, again, so to make it very clear, depending on how you're positioned, I mean, you could take a shot here. I'm going to show you micro levels in a second. But this is what you really want to see, a break of that trend line. And again, a break of that 55.91, we'll call it right there. That will most likely start to bring in some selling and get this thing going to the downside. And this is the next big support down there. There's obviously, you can see my other support levels along the way, but 540, 54.41, 54.42-ish right there is probably an important support level too. That'll, and the way it works, guys, if and as each support level is broken, it opens the door for move down to the next one. And so the deeper you go, the better the odds are you're going to get down here. And we start getting down anywhere near the lows, it's going to be, I think we'll just go right on down through there and the VIX will explode. All right, those are your levels on ES. I'll get to the ETFs in a second for you. NASDAQ 100, there was our bearish engulfing candle there. We had a breakdown, sell signal after the trend line break, another trend line break, back test. And this is right now, here's my lines. I've added, this is the line I was highlighting up until, well, I've been highlighting until we broke it a couple days ago. Went sideways, slightly higher. Again, we have very clear, unmistakable negative divergence on the 60-minute chart. That's when I like to go long on divergent lows, and I cover shorts, go long. Especially this is my go-to swing trading time frame. So if they take this divergence out, if NQ holds this trend line, this is the trend line I added today. These are now the important ones. Because again, this one's already been broken. Comes off the lows, comes in, catches a low there, that next reaction low, and we've been skating on it. I'm going to zoom in for you a little tighter so you can see it. That's it. That's the level to watch. I had a comparable level a little bit below on it's probably about right here, that level I had for you on ES, which I think is important. I'm going to say right about here, this recent low right there, that should do the trick. So what you want to see if you're looking to short or add to shorts or get into shorts, you want to see a solid, first of all, a solid close, especially a 60-minute close below this uptrend line right here. All the better if you can take out that 19,543 right there. That should do the trick. Likewise, if you are bullish or long or wanting to get long, you're at support right now. So the only play was when the market's at support, you can either go long with a stop below support, and I also, if you want to give it a little room right there, or you wait for a breakout above resistance. Now, just like ES, we've had that divergence building on the NASDAQ 100 futures here. Any new high anytime soon will still be a divergent high, and that gives it a higher rate of failing. So you can draw it out this way. And again, I'm going to give you some micro levels here in just a second that are going to determine whether we do this, whether we have a nice green close today or a red close. So if we go up a little more, we have plenty of room on the indicators for a marginal new, slightly higher high. This is kind of the last, escape velocity starts to really, the odds go up when we take out yesterday's high. Because that was resistance on the daily chart. This is the final resistance. You can see this was a really good level. Reaction high, a breakout, back test. And when that breakout failed, this was a breakout to new all-time highs. When it failed, it was pretty impulsive. And that number is at 20,350 right there. That is kind of it. If you take that out, the last high in the market in November of 2001, you came within spitting distance of the previous highs. I think I showed you that. If not, I'll do it right here. Turn off all the lines. This was November, back when we topped. And where's my little scrunchy tool? There it is. You can see right there. There was the peak. The market rallied almost back to that peak, but failed just below. So it is possible. But usually you get that close and you're going to punch the highs. I'm just trying to show you. And so you can see from on the QQQ chart, remember, this was the level yesterday, 486.80. big level. That was our previous high, all-time high, breakout, and the breakout failed right there. That's why that level's technically significant, and that's why that'll probably be that escape velocity where that just you don't need any more thrusters, any more thrust. You're just going to go on and escape the atmosphere of the Earth or whatever, the gravitational pull. That's what the rocket science term when you no longer need to use thrust because you're breaking free of Earth's gravity, and that's. But I do have to say that is, I would be remiss not to point out, that's a very significant gap right there. You can see it was a breakdown. It was that sell signal and break below this bearish rising wedge right here. You had that uptrend line, the divergence, we gap down below it. There's the bottom of the gap, pretty much the level I told you here, 46.80, and then top of the gap. Not really no resistance other than the previous reaction high above that, but usually the market has a history of not double, every time it makes one of these marginal new highs, it pops and goes above the previous one. Okay, let me get nitty gritty real quick. We'll go down to the 1 minute chart. So this is what I was looking at today, and there was a nice trade to be made of watching the Powell pop. So remember, Powell spoke at 10 a.m. At Jackson Hole, and even before his mouth opened, the market, because we all knew, look, anybody that does this knows that it was about 100% certainty, and it was and still is, that he's going to cut rates. So he's pivoted. He's pivoted clearly in rhetoric. That was just solidified today. That's all he did. He solidified that and said it without mixing words. And so it's baked in the cake, as the futures were already, the Fed funds futures were already predicting we're either going to get a 25 or 50 basis point cut. That's baked in the cake. So if I can't say officially the Fed's pivoted, they officially pivot once they get the cut. And I'm going to get to that in 1 second towards the end of the video, the rate hiking Fed funds rate. All right. So what I noticed, you can see these lines I'll put up here about 10:30 this morning when I was watching, popped up the little, if you use the Thinkorswim platform, they've got a feature in there. You can pop up a live streaming feed from CNBC. It's good because there's no commercials too. Commercials hurt my brain. So they just put a blank screen when it goes to commercial. Anyways, you could have watched that. I was watching them talk, and that's when he came on the stage right there at 10 a.m., this big green candle. And so I was putting up these volume of price histogram bars. Now they've changed, but this morning, the way you use these volume of price histogram bars, that's these green and red bars that come out of the side. It shows you how much volume occurred at each trading price. And so I set up these lines. You can see here, a pop-up box says at 10:35 a.m., which was right here. And so that means everybody that bought into the pop, you could see this is where they were, and that was a very, that's why I placed a line there where the histogram bars were the thickest. Again, these bars have populated since. When I did them, you can see, you can just go back in time here and grab this little doohickey here. So at 10:35, that's how they looked. So you can see there was a clear void, and I'm just showing you how to use these. So that's why I placed a line there, and it was good for a quick short trade once we broke it, because that tells you that all the, I need to use my words carefully. I want to call it fools. It was a fool's rally. Again, Powell didn't say anything that wasn't expected. So what were they buying it for? And so you can see that the volume price histogram bars I showed you, it was a clear delineation of the, there was a void below it. And those voids work just like gaps. Again, these bars have been populated since. I just showed you they weren't there before. So the second we broke it, it was good for a quick over a 1% drop down the lows. 1% on QQQ, 0.9. And so that's the level today. And look, I haven't touched this line again. You can see it was created at 10:35. It's not been edited. And you can see how well it's been working. So I usually don't go down to 1 minute charts for swing and trend trading. But today's Friday. I think it's a pivotal day based on everything I just showed you on the 15-minute or 60-minute charts. And so this is the level that if they can pop it, a solid pop, a solid close, solid, we get up here, 1 minute bars, maybe even a 5-minute close, we're probably going to have a nice big green day. The markets could be up, 2-3% easy. Right now we're only up 3/4%. However, as you've heard me say many times before, support is support until unless broken. It was broken there. Once support is broken, it becomes resistance. And as I also say, resistance is resistance until unless taken out. So again, I don't often, in speaking to swing traders, as I'm trying to do in this video, talk about the 1-minute charts that much. But right now, today, this is it's a very near-term battle. And, it's just like any war. You win enough battles, you win the war. So right now, bears want to keep it below here. Bulls want to take that level out for today. And then that can determine where we go next week. Now, I also did it, you can see here on all the market leaders. Apple created that line at 10:33 a.m., right? 10:33 was right here. And when Apple broke it, we dropped 0.75%, broke it right there. Hard selling down into this low. And look at this. It's still below it. So this is the top component of the NASDAQ 100. Second largest is NVIDIA. This line I already had. This is the one I created this morning right here. That was, again, where the volume price histogram bar was thickest when Powell was talking. That's where it broke. NVIDIA did regain it, but right now it's right back on there. So a little below it, actually. And again, that line was created back there at 10:29 a.m. Microsoft below it, same level. Again, created here. There was when Powell was talking, the giddiness in the market. And then it broke, rejected. So far, bears are in control today. Look, the market's green. Don't get me wrong. This stock isn't. This is Microsoft. Alphabet, you can see right there, broke it, back tested, tried to get above there, but again, this is collectively. So why here's a green print, Alphabet tried to get above there, but the QQQ was getting rejected at the same time, or Apple was, and so it failed, and we're below it now. Again, these are all lines created earlier, and they're just kind of near-term stuff. Amazon, same thing, below it, tried to get back above. Meta, that's when it broke it right there. Again, it was based on how things looked at the time, and we're down below it. So Broadcom, I have two here that I've added today. We're below both of them. And I'll even, on a 1-minute chart, you can see right about here. This is all today's trading, by the way, right here. We open the market there. This is Broadcom is one of the top components of the NASDAQ 100, so these are all levels to watch. Bullish if it can break these out, but right now it's bearish. And so at the end of the day, again, let me go back to QQQ. It was a lot of giddiness. I have very little doubt that blew out a lot of weak-handed shorts, I call them. You've heard me say it 100 or a million times over the years. On Fed days, and this wasn't a Fed day, again, it was Powell just talked, but as it had every bit of as much significance, everyone was waiting for a long time to hear what he'd say. Jackson Hole, it's known to be a pivotal time for the Fed if there's any kind of big statements there. So the market hangs on his words. But my point is that those that jumped into the rally, what I was saying a minute ago is, on those FOMC days, you've heard me say I call it post-FOMC noise, even though it wasn't a FOMC meeting. We get that next month. It had every bit as much significance, and this is that noise, meaning don't read too much into it. And I often say, you've heard me say this a million times as well, the initial reaction to an FOMC meeting or Powell's comments that come after, FOMC decisions always released at 2 p.m. on the Fed days, and then the Powell's press conference starts at 2:30. And, as I often say, the initial reaction quite often isn't the lasting one. Now, so again, the takeaway is I'm spending a lot of time on 1-minute charts. I usually don't do that. Near term, it's going to be bullish if you get back, QQQ gets back above here, especially if they get above the top of that range, right? We're going to look at a pretty healthy green close. Otherwise, a lot of shorts got blown out, which kind of clears the way for at least a bigger drop. You don't want When I'm shorting, I want to be the only one short. I don't want to be. I don't like safety in numbers going with the crowd, because when a stock or a market or an index has high short interest, that's usually, it limits the downside to it, because short sellers will cover on dips. They take profits. So the markets that fall hardest are those that are, or stocks are those that have very little or low short interest. Okay, guys, so there it is. There's your micro levels. You can replicate them, do what you want with them. 60-minute chart of QQQ. Again, same uptrend line comes off the recent lows on August 5th, right there. That's a level to watch. So right now, this was a divergent high. Has the potential to be the end of the rally. I could see a little bit more upside, but not much more is what I don't want to see. And at that point, I'll be scaling out of short positions. I have my fill at this point in time, but I also actively trade my active trading account. And I'll most likely, if I have to see one uptime, I'm going to leave today. I'm probably not going to establish any new positions. I might take 1-2 more day trades before the day's over. But I just want to point out, if today wasn't a Friday, if it was a Monday, Tuesday, Wednesday, and we didn't have the extra 2 days overnight risk, I would say this is a good time to short if we get a break of that. And it is, look, it's going to be objective, because if we break that level, we close solidly below there today. And again, I'm going to pull this line down here, guys, and I'm going to tweak this and give you the BOD level, benefit of the doubt, which I did on the futures. I gave you that earlier. See these two reaction lows? So there's a trend line. So bearish if we break that, especially a solid 60-minute close. But if you want to give it the benefit of the doubt, that's about 473.77. If we take that out, we're going to close red today, and we're probably going to go down next week. If the bulls can rally it up here, especially they take out those little micro levels, resistance levels I just gave you on the 1-minute chart, yeah, it's probably going to be a green day, and we're going to go up within this wedge. Doesn't change the technical posture. The only time the technical posture is going to change, you can see, my extension lines here. Let me show you. This is our current divergence. We can go up a little bit more. It would give us a nice clean separation here. There's our divergence, and looks something like that. So again, I'm willing to see that. Anything much more than that, you start taking away the divergence, you start popping resistance levels that should cap the advance, and yeah, we're probably going to see new highs if that happens. Okay, that's pretty detailed, and again, you know which way I think we're going, but the way that works, the way my brain works is you need to break these support levels to increase my confidence or the probability that we are going to go down, and that this was the end of a counter trend bounce, or this will be if we get up there. And then same story next week. If we pop, close green today, and then we set up this wedge, and then next week it breaks down, well, then that's your sell signal, right? There's your objective short when the wedge breaks. And then again under 473.77. And to conclude this video, and again, not to beat a dead horse, I know I've covered this quite a bit recently, but it bears repeating, especially if, some of you might be new to the site or haven't come in a while. What Powell's remarks today did, because again, he didn't mix words. He made it very clear the Fed has pretty much pivoted to a dovish bias, that the next change in rates will be to the downside. It'll probably be coming at the next meeting. So he did everything but actually cut rates today. And again, there's we're looking at a chart here that goes back into the 40s. This is a 62-year history of the federal funds rate. And again, this bears repeating, with zero exceptions, with no variability after a rate hiking cycle. When the Fed pivots, meaning they start cutting rates, and it's when they start cutting, then the recession inevitably has followed. Again, sometimes they raise and then they hold tight for a little while, just like now. They sit there and then they cut, and then again with virtually zero lag. So it's not an exact timing indicator, but it's pretty damn close. And you can pull this chart. These are all the recessions, all these gray shaded areas. And you can see rate hike cycle, pivot. Sometimes you pivot right away. There was a pivot right there. The first pivot, we went down. There was an inflection. The recession came. This was a pivot right here. This was crazy times when Fed funds rate got over 20%. But that was the first pivot right there. The recession followed. They had another rate hiking cycle because inflation was out of control. They pivoted right there. Recession followed. There was your pivot. That one took a little while, but the recession certainly did follow. There was the pivot, the reversal. The recession followed. There was a plateau like this time around. Then they started cutting. Then the recession followed. Pivot, cut, recession, COVID, but it was there. It was a pretty powerful recession, but it was a quick one. And here we are now. So what today did, just to be clear, all but solidified, again, looking at probability, that's all we can do, statistics, probability, history. There is a virtual near certainty now that a recession is imminent based on this past pattern. The Fed doesn't start cutting rates randomly. And, the market will, and it's done this, it's rallied up to it. They bought it today. And again, these are, no offense, but these are pimple-faced kids coming out of, business school, starting at Goldman Sachs trading desk, given a job, maybe, unexperienced hedge fund managers or whatever, that just tend to forget that this is an immutable pattern here. It's never once changed. So same thing with the when you look at the unemployment, and there's a lot of indicators that show this. I've covered this one, and then I'll end the video here. You have all these zigs and zags in a downtrend, but employment, again, what's immutable and has not ever changed is employment is always has moved in V's. It's full throttle up, full throttle down, and the inflection points, the turns have always been, as I'm drawing it out here, V's. These are like the letter V, and it never has changed, and it just kills me that when I watch and again, I understand the industry is inherently bullish. I come from that industry. I used to be a financial advisor, stockbroker, and I was fed the Kool-Aid for years. They have to. Then 99% of them are long side only, so they have a vested interest in convincing the masses that the stock market will always go up and the economy is always going to go up. But recessions are a natural part of the business cycle. And again, these charts don't lie. And so although you do get these little variation, squiggles in the, as the employment reports come out, this one monthly, once the turn is very clear, again, you've never ever in history seen it increase this much as we have, and that not be the bottom. There's the V, the beginning of the V. This is a lot more than any of these little, what I call micro squiggles on the way down. And then invariably, with zero exceptions, a recession has followed. So, look, can it be different this time? That's the old famous thing, it's a kind of a joke. It's going to be different this time. We're just looking back. We're going back here. This is what, 70, 80 years, something like that. And it shows that once the turn is in, that's it. It doesn't do this. It doesn't go sideways for a while. It V's, and this is clearly more than just a brief aberration. The trend has clearly shifted to up. These are higher highs and higher lows as we zoom in here real tight. And there's all years. That's going back to 1948. So where am I going, guys? So the market, the stock market, and the economy are not the same. Is it possible, we can put in a marginal new high? That's it, at best. So, but there's still enough evidence, in my opinion, was enough evidence that we put in a major top, and the top, as I gave you back before we got to the top, where the market would likely top, and give you this market top range back on June 26, when we were right here, June 26, right here, down here, and said the market would most likely top anywhere from here down to here in this box, and we got 1.5% to the top of my range. Then we were greeted pleasantly with sell signals such as a bearish engulfing candlestick, a break of the uptrend line, a break of the secondary uptrend line, break of the 50-day moving average, and all these other things. And so this was just a rally back to, and that level wasn't just random, it was there because it was a resistance level. And that's the same resistance level we just rallied into right now. And so I'll leave it there, guys. I think we're at a, technically significant level. If the bulls are going to punch it up and prolong this, I have little doubt a recession is coming based on those economic indicators. And there's many others. Those are just the two that are pretty much very reliable and very clear right now. And we can do that. I won't want to ride it out short. So like I said, if we can get up there, I'll let you know my plan. Today I'm doing nothing. I'm leaving town today. There's nothing today that's going to change. We'd have to close up 10% higher, and it's not going to happen. Market doesn't go up 10% a day for me to, for the technical outlook to change. But as of now, my thoughts, the levels to look for. And if we get a red close today, that's going to be nice. It's going to be pretty darn nice for the bearish case, because then we'll be able to take out this uptrend line. And especially if we take that level just below, that's going to be a breakdown, and that will most likely follow through next week. We can have a ugly week next week, especially if this was the end of the bear market rally, or not bear market rally, the rally off the August 5th lows, which I think there's a good chance it was. Let me wrap it up here. I'll get the video out to you guys. And if I see anything crazy or any opportunities before I wrap up today, I'll get those out to you. Otherwise, this will be my last and only video for the day. So this has been Randy Finney with Right Side of the Chart. Have a great weekend.